Since the pandemic hit 5 years ago, back in 2020, the worst performing sector in the S&P 500 has been real estate. Looking here at this chart, if you look at the far right column, you will see the 5-year performance by sector. No surprise to see technology and communication services at the top. But if you look at the bottom, you will see real estate bringing up the rear, up only 2.5% in a 5-year time span. That's not all that good. So a couple of takeaways. First is the fact of how much weight those top two sectors have carried. They're the only two sectors that have outperformed the index as a whole for the past 5 years. That could be concerning right there because you see all of these Mag 7 stocks are found primarily in those two sectors, meaning although the S&P 500 has done well over a 5-year time span, the rest of the market isn't doing all that well. And the second takeaway is the fact that real estate has gotten hammered. This is a sector that is very interest rate sensitive, and we have seen sky-high inflation, which brought about very high interest rates. Now, what's the upbeat that we're looking at? The outlook. We already know from the Fed that interest rates should be coming down over the next few years. Now, they may not be coming down as fast as we had hoped, but they are coming down. So for that reason, we're not looking to back the truck up on REITs, but this is a period of accumulation because 2 to 5 years from now, you're going to be looking back saying, I wish I bought more of this REIT or that REIT, because we know interest rates should be coming down over the next few years. As such, in today's video, we're going to be taking a look at 3 dirt cheap REITs that you could start accumulating right now at these particular levels. But before we do that, do me a huge favor. Click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now you can check out their 10 best stocks to buy by simply going to fool.com/Mark. All right, let's jump back into our video taking a look at 3 dirt cheap REITs, beginning with REIT number 1, which is Realty Income, stock ticker O. Now this one may surprise you for those of you that have been watching my videos for some time because I've put out plenty of videos giving you other options outside of Realty Income. And my distaste for them and the lack of growth still holds true. But at the same time, those are great options. Realty Income is still a high quality REIT. They may not be growing at the same pace that they once did, but right now, at this valuation, it is way too low. The company currently has a market cap of $50 billion. It is a net lease retail REIT, and over the past 12 months, shares are up 8%. However, over the past 5 years, Realty Income shares have sunk roughly 30%. That is a brutal 5-year performance. And I also do want to give you heads up that by the time this video is published, the company will have released their most recent financial results. So definitely take a close look at those before investing. However, when it comes to Realty Income, they're often the gold standard, the REIT that put the REIT sector on the map. And you may hear many refer to them as the monthly dividend company, as they pay out their dividend every single month. Which, speaking of the dividend, the company currently yields 5.6% to go along with a 5-year dividend growth rate of 4%, and they have increased their dividend for more than 25 consecutive years, making them a dividend aristocrat, a rarity for the REIT sector. With these high-yield stocks, you can't expect much in terms of dividend growth. So although Realty Income consistently increases its dividend, it doesn't increase it by a high percentage rate. And a lot of that has to do with the structure of REITs. However, when it comes to investing, we should never invest based on yield alone. So let's check out more about the company. And again, we will be getting updated figures prior to this video coming out. But as of now, this is a company with an A- credit rating. No changes will be there, and they have a portfolio of more than 15,000 properties. It's also a company with a global presence. The company has a strong management team that has proven itself over time, and shares have compounded at an annual rate of 14.1%. That's in terms of total return since its IPO back in 1994. In addition, the company has 29 straight years of positive operational returns and is poised for continued growth moving forward. Here's a closer look at the portfolio, where the top tenants include Dollar General, Walgreens, and Dollar Tree. not 3 top tenants that get me all that excited, since there's a high probability that one or all of these 3 may not be around the next 5 to 10 years, which could be a concern. However, those tenants only account for roughly 3% each of all the rent this company collects, as it's extremely well diversified. The top industries include grocery, convenience stores, and dollar stores, and retail is the largest property type by nearly 80%. The management team, which I've had the great honor of interviewing on multiple occasions, has done a great job diversifying the portfolio over the past few years. For example, they have investments in a JV that's related to data centers. They've also been investing more in casinos, in hospitality, breaking away a little bit from the traditional retail. Now let's turn our attention to valuation. As you can see here on the fast graphs chart, analysts are looking for the company to generate AFFO of $4.32 in 2025, which equates to a forward price to AFFO of just 13.1 times. That is dirt cheap right there. This compared to their 5-year average of 17.2. But maybe this isn't a company that warrants a 17.2 multiple anymore, because the growth has come down a lot. But even if they traded closer to 16 times, which is the average for this sub-net lease retail sector, at 16 times, the stock could reach $69 per share at that valuation, which would warrant 21% upside outside of the dividend. Again, a dirt cheap REIT with a strong balance sheet and a strong track record. And that leads us to REIT number 2, which is going to be Stag Industrial, stock ticker STAG. Stag Industrial is another well-known REIT, not as large as Realty Income by any means, but they also happen to be another REIT that pays a monthly dividend. Some income investors love that fact, and we'll get more into the dividend here in a second. But let's take a closer look at the size of the company and its shares. The company currently has a market cap of $7 billion. It is an industrial REIT, and over the past 12 months, shares are down 8%. Over the past 5 years, though, they have flipped the script and they are up 8%. That is a 5-year average that's more in line with the REIT sector as a whole, as industrials did not get hit as hard as retail REITs did during the pandemic. But why are we so optimistic on industrial REITs, you might ask? Well, I'm so glad you asked. And the first reason is due in large part to the growth in e-commerce. As you can see here right now, e-commerce sales account for less than 20% of total retail sales. And as you can also see over in Europe and the UK more specifically, sales for e-commerce is nearly 30%. I expect this penetration to grow more and more over the years, which is going to benefit an industrial REIT like Stag Industrial. Another reason to be optimistic is the fact that many businesses are onshoring more of their inventory. And on top of that, with all of the tariff talk that's taking place, that's just going to further speed up that, bringing more inventory, which means and requires more industrial space, benefiting the Stag Industrials and the Prologises of the world. Third and fourth, I love the dividend, stable, consistent dividend, and I love the valuation. Let's begin with the dividend first, which the company currently yields 4.2%. As I mentioned, they pay out their dividend on a monthly basis, and they have 12 consecutive years of dividend growth. Now let's take a closer look at the portfolio, where Stag is a company that went IPO back in 2011 and now has nearly 580 properties within its growing portfolio. Their top tenant happens to be Amazon.com. Now taking a look at valuation, and as you can see here on this fast graphs chart, analysts are looking for the company to generate AFFO of $2.10 in 2025, which equates to a forward price to AFFO of just 16.6 times. This is well below their 5-year average of nearly 19 times. At their normal 18.6 multiple, this is a stock that could reach $40 per share, and at that valuation, it would warrant another 15% upside to go along with that large dividend that they pay out. But I believe we could also see multiple expansion with this stock as AFFO growth continues to increase in the coming years. And that leads us to REIT number 3, which is going to be Gaming and Leisure Property, stock ticker GLPI. And if you've watched any of my REIT videos in the past, or maybe you're a subscriber to my newsletter, The Stock Investor's Edge, where you get access to my entire portfolio. And if you're not yet a subscriber, check out the link down in the description below and get subscribed today. But within the portfolio there, you would see that my largest REIT holding happens to be Wich Properties, which is another cheap REIT that I could have added to this list as well. But GLPI is a close competitor operating in the same exact sector. The company currently has a market cap of $13 billion, and the REIT operates as a hospitality REIT, owning casinos and hotels. Over the past 12 months, shares are up 8%. Over the past 5 years, down 2%. When it comes to owning a hospitality REIT that owns hotels as well as gaming properties, you really need the consumer to be on solid footing. So if you do not believe that consumers are currently doing okay and the labor force is doing okay, or if you believe that the labor force is going to see an uptick in unemployment, this REIT may not be for you. It may imply a lot more risk than you're willing to take. But if you do believe that the consumer is on solid footing, then this is the stock that's going to have plenty of upside, both from a share price appreciation and its solid high yield dividend. Speaking of that dividend, the company currently yields a dividend of 6.2%, the highest on today's list. They have increased it for 4 consecutive years now, as they had to cut that to preserve cash back in 2020 during the pandemic. Now let's take a closer look at the portfolio, where the company currently has a portfolio of nearly 70 gaming properties across 20 states, all here in the U.S., scattered across the country. But the largest footing is east of the Mississippi. Their top tenants include Penn, Boyd Gaming, Caesars, and Bally's. Now let's take a look at valuation, where, as you can see on this fast graphs chart, analysts are looking for the company to generate AFFO of $3.91 per share in 2025, which equates to an AFFO multiple of just 12.5 times. This is well below their 5-year average of 14 times. And at that normal 14 times multiple, this is a stock that could reach $55 per share at that valuation, which would warrant close to another 15% upside to go along with that 6% dividend yield. So there we just looked at 3 REITs, 3 very different REITs across all different levels. You had Realty Income, which is largely known as the gold standard when it comes to REITs, the monthly dividend company. You have Stag Industrial, which also pays a monthly dividend like Realty Income. And then we had a gaming hospitality REIT, very similar to that of wich, which is another great cheap REIT to look at right now. So in the comments section below, let me know, which of these 3 REITs do you like best? Would you be investing in? And which ones are you already investing in? If you haven't done so yet, make sure you simply click that like button down below to show your appreciation. Subscribe to the channel, and we'll see you in the next one. Take care.